Morning, ladies and gents. Simon Brown here. Today we're going to be we've been doing our Wednesday sessions looking at investing, touched on exchange traded funds, auto share invest, discretionary equity and ETF purchasing within the auto share invest, but that sits within standard bank internet banking. We've also touched on tax-free accounts, and I promised that what we will do, we've got 2 more sessions left in September, and we'll pick up on some, go deeper into some ratios and the like. And today, common mistakes for investors to avoid. Obviously, there's a huge number of these, some more important than others. And I thought let's delve into this for today's session. And there are a bunch of them, but I want to touch on some. Well, first one is panic. Markets go down. Sometimes they go down a lot, and sometimes they go down hectically fast. We saw that back in February, March, April of this year. We've also, I think it was 2018, where US markets and our markets as well went down, not quite as much, only by about 20%. Earlier this year was closer to 40%. Markets do go down and they do collapse. We can call them crashes, call them collapses, call them what you will. This is going to happen from time to time. And the point is, don't get panicked. Have a long-term view. And it's what I said in some of the early sessions that we've been doing here, is that we need to come to market with a long-term view. If you need your investment in the next 3, truthfully, 5 years' time, you are much better off not going into the market. Because imagine if you'd needed your money in April. You would have been, forced seller at those lows because you needed to get that cash out of the market. So, panic is real, but we need to understand that much as we love to see markets going up, doesn't always happen. Sometimes they go down, and we manage that panic process by having that long-term view. We also manage it with diversifying. I'm going to come to that in 2 points time. But certainly a long-term view. And then the other common mistake is waiting, sitting on the sidelines, sitting on cash, usually for one of 2 reasons. You're worried that markets are expensive. You're worried that markets are about to crash. And that concern, and if you go onto the interwebs and you Google around, you'll always find large swaths of people who tell you that markets are expensive, markets are about to crash. You seldom find people who are saying, markets are at record cheap levels, time to jump. You don't really hear that at all. So waiting on the sidelines, and I manage that. Timing markets is hard. And again, it comes back to that long-term view. When I'm buying individual shares, yes, then I'm more interested in the valuations of those shares and the like. However, when I'm simply just buying myself a ETF, and I do ETF purchases on a monthly basis, when I'm buying myself ETF purchases on my monthly basis, I'm a lot less stressed about the actual pricing and the timing and where they're going to be. As I said earlier, when markets are 20% off their highs, I will double those purchases. So in fact, when markets are going into crash mode or collapse mode, I'm actually buying more. Why? Because I've got a basket of shares. And ETFs, an individual stock might collapse and go to zero, but a basket of shares, they're not going to go to zero. They might have a long time of, of poor return, but they're going to give you return anyway. So it's that waiting and saying no. That you can lose all of your money. Well, you can lose all your money. Let's be quite clear about that. If you'd put every cent of your savings into Steinhoff or African Bank, the investment, not the bank that's out there right now, you would have lost 99% of your money. Not quite all of it. There are certainly companies that have gone bankrupt. If you had your money in Pumlela, you're probably going to get nothing back. Group 5. So certainly you can lose all your money, but you manage that fear by diversification. The easiest way to diversify is an ETF, an exchange-traded fund. That immediately, depending which ETF you buy, is going to give you somewhere between, 25 and 1,600 shares, locally and or offshore. Some of them also have cash and bonds in there. So you manage it by diversifying. If you don't want the ETF route, you diversify by having shares, not only different shares, but in different sectors, in different geographies, different businesses. So you don't go and buy 6 banks. Then all you got is banks. That's not diversified within the banking sector, but you are very much in the banking sector. You're better off diversifying across different sectors. Banks, miners, retailers, manufacturers, property, listed property, and so that list goes on. So you can lose a vast amount of money, but that's an easy one to fix. And you fix it by saying, well, hang on a sec, let me not put all my eggs in one basket. And I've spoken before around the idea of a sort of a core portfolio of exchange traded funds. And what that core portfolio does for you is it's somewhere between 50 and maybe even 100% of your portfolio, and you go into that, and that's your diversification. Instantly, easy, quick, and cheap because they're ETFs. And then around that, you have individual shares that then come and work for you. Someone's asking, could I do something in how to structure a portfolio? It's a great idea. I'll do that one. So next week, I want to do 23rd. I'm going to do some details around, return on equities and all of those, sort of delving into some ratios. But 30th of September, let's do that. How to structure a portfolio. Not understanding your investment. It's very important that you only invest in what makes sense. And that's not just around the shares. You've got to make sure that if you're buying a share, you understand how it makes its profit, what is its risks, etc. If you're buying an ETF, what is the methodology around that? Satrix has just launched a couple of ESG ETFs. You got to understand what is ESG, what are you getting, what are you maybe giving up. As soon as we move into sort of more exotic structured products, there's a lot of structured products in the market, derivatives, warrants, all of those sort of things. Make very sure that you understand how they work and what they are and what the benefits are and what the problems are, what the risks are. It's not just maybe the risk inherent within the whatever you're investing into ultimately, but the actual structure, the product itself. Does that add extra layers of cost or risk or something to you? So really understand what you are investing, understand your investment, and ask questions. Get on the Twitter, get on the YouTube, contact the provider, make sure that you understand. And don't take for an answer. If someone says, "Oh, don't worry, it's complicated, but it's fine." That's not an answer. That's not good enough. It's complicated, but it's fine. Doesn't crack it. You need more than that to really be comfortable in a sense. Hot trends. Hot trends is tricky. Do you? And I suppose the point with hot trends, Tesla could be a hot trend. The big tech stocks. Now let's park Tesla on the side for a moment. I'll come back to that in a second. The big tech stocks, your Amazons, Facebooks, Alphabet, which is Google, Microsoft, etc. They're not even really a hot trend anymore. They just make money. They are profitable. But then the valuations get expensive at some point. We've spoken about valuations in earlier sessions. Tesla's a hot trend. Is Tesla the future of electric vehicles? Maybe. Maybe not, and I'm not, I have nothing against Tesla, but any company can hit the wall for one or another, myriad of different reasons. But the case more than anything is, I'm not saying don't buy Tesla. I'm saying don't put everything you have into Tesla. Again, it goes back to that diversification. Understand that those hot trends, those hot new sectors, they carry additional risk. Tesla's risk is, not just they've proved that they can produce the vehicles, but now they've got to produce them on scale. And can they be viewed as just another motor vehicle company? When the electric part, as opposed to combustion engines, becomes less thrilling and exciting, much more commonplace, then, so Tesla might succeed, but the share price might be lower in a decade because now it's getting valued as, well, it just makes cars. Sure, they're electric. And hey, once upon a time that was exciting, but now that's very much the norm. Focusing only on the next big thing, and that's what I'm talking about with Tesla. Nothing against Tesla, but I know people who've put literally their entire net worth into silver because silver is what it's all going to be about. In essence, you're rolling the dice. You're going to the casino, putting all your money on 17, and saying, cool, 17 comes out, I'm rich, and if it doesn't, well, heck, there's nothing left. And again, diversify. Yes, we're going to miss some. And while waiting, we'll miss some others. But don't put all your eggs into that one basket. As I said, when you structure a portfolio, you've got that core of ETFs. As you run up, right at the top, a couple of percentage of your portfolio, that might be your more speculative. Some people might use that for derivatives. Others might say, I want to look at these hot new spaces. Robotics, AI, those sort of things. Maybe an ETF around that to reduce some single stock risk, but certainly not everything into it. High fees. Fees are a cost. and a cost is therefore taken out of your return. So keep those fees low. And we live in a glorious age of investing in terms of fees, in that fees are typically fairly low. We can get amazing, in terms of transaction fees. And that massively benefits us as an investor, because it means more of our money is being invested, means we're ultimately making more profit. But what it also means is, don't ignore the fees. Focus on them. And if the fees seem a bit higher, well, why? What's the purpose of those fees? Why are you paying extra for this over that? I mentioned the ESG ETS out of Satrix, and they're on, they're less than 0.5% annual fee, which is incredibly cheap, but they're higher than a sort of general S&P 500 ETF. Why? Well, because ESG. There's an extra layer of complexity / cost in that process that needs to be taken into account. So constantly focus on your fees, and there's a couple of fees. There's a transaction fee. There's an admin fee. There might be an advisor fee, platform fees. There's different layers of those fees. In the unit trust and ETF space, it's total expense ratios. Make sure you understand what they are. Make sure you understand all of them, and make sure you're comfortable with them. I got no problem with paying. There's no free lunches. You're going to have to pay, and that's fine. Make sure you're getting bang for buck, and make sure you know what you're paying. Don't just sort of like, it'll all be fine. No. Make sure you know what you're paying. And buying hot tips from the bra. We see it from time to time as suddenly stock markets become hugely more exciting, and then suddenly everyone's got a hot tip. I was chatting with somebody yesterday who was told to buy a share because it was 1 cent, and it went to 2 cents, it'll double in value. Well, it didn't go to 2 cents, it got consolidated, and effectively that 1 cent share is now trading at the equivalent of 0.2 cents. I mean, it's 1 cent, I can't lose. No, you can lose. Until something is at zero, it can always go lower. When it hits zero, then it can't go lower. Then it has reached bottom. But hot tips, and I'm not even saying that these hot tips are nefarious, that the person has got ulterior motives. I'm just saying that they don't necessarily know your strategy. They don't necessarily have the full information. They don't necessarily actually know very much about much. The person who got tipped to buy that sounds like an easy bought, the ups and downs of a very, very volatile path to get here. But more than that, what if you didn't buy Amazon? What if you bought WorldCon instead and WorldCon went bankrupt? Or what if you bought Steinhoff and it went bust? I mean, so really a sense of don't go all in, always be diversifying. And then constantly switching investments. You buy this one because it's the hot new flavor, and a couple of weeks later you're like, but it hasn't done anything. But look what that one did. FOMO, fear of missing out. So you jump into the next hot thing and you're constantly chasing. And the fees, which might be low per single transaction, but ultimately those fees are going to hurt. They're going to constantly be costing you because you're going to be jumping from one to the other, and they will ultimately erode those profits. So, again, it comes back to, I think the easiest thing we can say, common mistakes for investors to avoid. I think the first is have a plan, and the second is diversify. And in truth, those are partly the same. Your plan should be in part to diversify. Your plan should be long-term, 5 years or more. Have that plan, have that diversification. I'm not saying you can't go and buy some hot stocks and hot sectors. I'm not saying you can't go and buy some AI or Tesla or something, but make that a small part of it and make it part of your plan. Have your portfolio and say, right, I will set aside 5% for those perhaps more speculative positions, whatever they might be. But have that plan and stick to it. And that more than anything is what's important. And then don't panic. It's easy to say, but avoid the panicking. So have that plan, keep it simple, remember long term, and keep the fees low. And as I said, if the fees are higher, interrogate why, and there might be a very good reason for it, and that is fine. But having a plan, keeping it simple, focusing on the long term and focusing on the fees. If you get those 4 things right and you're diversifying, then you are going to avoid the mistakes that are out there. And by avoiding the mistakes, you will get better returns from it. Ladies and gents, we leave that there. Remember, 3 times a week, Mondays, Wednesdays, Fridays. Wednesdays, we got until the end of September focusing on this series. And then Fridays is our ETF. And Mondays, myself and Dineo talking markets. Everyone, have a great day further. I'm going to clean up the edit a bit so we can get out some of that mess in the middle when I lost the connection. But everyone, stay safe out there. Cheers all.